moving slightly higher. Thursday, Morgan Stanley and Bank of America round out the Big Six when it comes to the reveal of earnings. The Big Six, we've talked about that. Let's go to the Mag 7. Let's roll these out side by side so you can see how pretty much all of them appear to have very similar intraday chart patterns. Look at NVIDIA. NVIDIA down 2% at the moment. Alphabet lower by 1%, but their charts mimic each other. Both managed earlier to climb a couple of bucks above Monday's close, but right now you see they are both now south of the border. By the way, the slice that you see coming off of NVIDIA brings its 5-day loss to 14%. Look at Amazon and Microsoft, two more Magnificent Seven stocks. Same picture, except that Amazon was able to hold on to the green just a little bit longer this afternoon. Flip it over to Apple and Tesla. So at the moment, we've got Apple moving down about 0.2%. Tesla, though, Tesla got as high as $422 just after the opening bell. It was in the green for most of it. But look at all it's lost. It now stands at $401.81. It is down about 0.33%. Now, this could be concerns that the Magnificent Seven are still overbought. And if you feel the same way, the floor show is going to tell you how to diversify in just a few minutes. But so we do have stocks mixed at the moment after initially popping on this morning's new inflation report. That was the producer price index, which showed that wholesale inflation, meaning what manufacturers pay for goods and materials, rose less than expected in December. That means prices are coming down, at least slightly, but still up. Bond yields, which yesterday, in the case of the 10-year, had hit 14-month highs, initially dipped in response. You can see that just after, I want to say, 9 a.m. Eastern. But intraday, the 10-year then went as high as 4.809%. And now it's at 4.79%. 2-year on the right, down about 1 basis point here to 4.37%. Why these jittery moves all around? Well, you could argue that investors now anxiously await more inflation data. Tomorrow in the morning, 8:30 a.m. Eastern, we get the latest consumer price index report. Economists expect consumer inflation to have risen 0.3% month over month in December and 2.8% year over year. Core, which is what the Fed scrutinizes because it eliminates the often volatile food and energy prices, is expected to climb 0.2% month over month, a tad lighter than the 0.3% jump we saw in November. And then core year over year, yeah, see that 3.3% number? If it goes in higher than that, that's not good. It's pretty much the same as the November read. And if we go higher than 3.3%, watch the markets. They could move and take the news badly. Listen, should you trade on CPI earnings or something entirely different? Let's get right to the floor show. Joining me now, Matson Money founder and CEO Mark Matson and Circle Squared Alternative Investment CEO Jeff Sika. Mark, what are you trading on, if anything? Is it going to be the CPI number, the earnings from the big financials? And then, of course, that just opens the floodgate for quarterly reports.
Yeah, I want to issue a warning to investors. You started off the show talking about the Magnificent Seven. Most investors are dramatically overweighted to just those few stocks. I call it the S&P 500 cult. Do not drink the Kool-Aid. Look, it was up 24% last year, the S&P, but half of that came from just these 7 stocks. And historically, if you don't learn history, you're doomed to repeat it. From 1995 to 2000, the S&P made 22% a year. NASDAQ stocks made 45%, but then they lost, large stocks lost 50%. Tech stocks lost 75%. Most investors have no idea how much danger they're playing with. You got to diversify because no one knows with their crystal ball what's going to happen. You got to own small. You got to own value. You got to own internationals. Don't get caught trying to overweight just to those 7 stocks. Big danger.
Sika's not a member of the cult. I know that. But Jeff, what are you joining when it comes to groups of sectors and names, subsectors?
Well, I mean, I think, Liz, the primary focus for me is that I'm looking at the inflation as being the number one worry, because inflation is the carbon monoxide of the economy. Why the market is being so volatile? It's trying to get a handle on exactly where we are with inflation. So what I see is I'm paying a lot more attention to these economic reports, and I agree 100% with Mark in saying that people have been over allocated in those 7 stocks. If you take Nvidia out of your portfolio, if you were in Nvidia, you haven't had the returns that a lot of people had, and you can't chase yesterday's stocks and expect the same returns.
Okay, I know that we have a lot of viewers who absolutely adore some of the Mag 7, but also the sort of halo effect out there, whether it's Palantir, Mark, or some of the other names, notwithstanding the fact that many of those have given people's portfolios a huge boost. You said the way to diversify is to go international and small and mid caps. Let me tackle the international part of it. There's a big world out there. Which countries?
Yeah, well, to answer that in the short, all of them. We're actually in 76 different countries. You know, markets are largely random. You never know what country is going to be the winner in any one period of time. What I can tell you, over the last 10 years, the U.S. has been at the top, which is a very dangerous sign for investors. So Asia, Europe, you want to be diversified even in emerging markets. And I agree with Jeff on this inflation thing. Look, most investors are kind of playing out on the yield curve into longer-term bonds. Inflation goes up, you're going to get killed on those bonds. So have short-term, high-quality bonds in your fixed income. That way, if equities do crash, you can rebalance, sell that fixed income, buy them while they're low. There's a very hard discipline for people to follow, but diversify internationally in all the countries, and then rebalance on the highs and lows. Easy to say, hard to do.
To you, Jeff, give me a sense of your outside trade at the moment. You know, we've got these wildfires, and of course, it's a horrific from a human suffering standpoint, but there is actually something regarding real estate you've been looking at.
Yeah, I mean, I think what I'm looking at is there's going to be a tremendous need when all of this chaos ends. There's going to be a significant need to rebuild what's been affected and destroyed in California. I think that there's going to be a lot of focus on the government and banks. I think what we're going to have to see is we're going to have to see the private equity firms step up and begin to direct money towards California. I like stocks like Ares and Blue Owl, companies that are in the private equity, private credit space. And I do think the banks are going to have to unlock some of this liquidity that they've been holding on to for so long and begin to deploy and begin to lend it out to rebuild one of the most important states in America.
Yeah, Ares Management, and you also like Blackstone. They have scooped up a lot of homes over the past several decades, I think since the financial crisis, I believe. Good to see you, Jeff. Mark, always a pleasure. Thank you both very much.
Pleasure.